What we'd love to know, and this is just for the whole panel, is, is there any part of that definition you agree with, not agree with? Do you think it even matters? Is it mattering when you're choosing who to go out to? Chris.
Okay.
And actually, wait, I'm going to go back one more step. I want everyone to introduce, I see them all, and I've actually seen them all pitch, so I know what they do, but they're all really great pitching. So, Chris, you actually want to start, explain who you are, what you do, and then we'll just go down the line?
Sure, I'm Chris Altchek, CEO and co-founder of Mike, Mike.com, MIC.com. That's a news site for the next generation.
My name is Krim. I'm co-founder of Casper.com, and it's a direct-to-consumer mattress and sleep product brand.
Hey everyone, my name is Alex Winter. I'm the CEO and founder of Placemeter, and we index the physical world in real time using computer vision and video feeds.
Hi, I'm Suzanne, founder and CEO of Hullabalu, and we're building the next generation Disney.
Hi, my name is Cheryl Swirnow, and I'm the co-founder and CEO of Sherpaa, and we are changing healthcare.
Nice. And so do you guys want to talk about where you are in the process of fundraising, what you've raised before and where you are now, and kind of, and to Ellie's point, how many months left before you start fundraising again?
Sure. We closed our Series A in April of this year for a total of $4 million in Series A. We raised our seed August of 2013, and we're going to be looking for Series B probably Q2 or Q3 to start that process in 2015.
And for you, what kind of metrics were you looking at to determine when to fundraise?
Yeah, so for us, it was really about, healthcare is a little bit different. For us, the practice of medicine is regulated across state lines. So our doctors have to be licensed in all of the states, basically. So for us, it was really a matter of sales. We couldn't get sales on multinational, multi-state national companies unless we had ample doctors and states, so we needed to push hard. So that's, we raised our Series A a little bit before when we needed to and when we would have, just because we wanted to push the gas, but we really had a nice sales story going into the Series A.
So we kind of a funnier story kind of when we started the company, but we raised our seed round before we'd launched anything, and it was kind of announced last June 2013. It was 1.8 million, and then we spent the last year really focusing on product and launching our first set of apps, and then we are just closed a smaller round. It's funny because it's kind of, we called it a Series Seed or a seed extension, but some people are calling it an A, and it was about 2.5 million.
And for the investors for that, did you have to go out to a different crew? Did you go out to the Series A? Did you go to the seed? Were some people pushing back?
Yeah, so we basically went out to our existing investors, and then all of the existing seed funds who were able to kind of follow on all did, and then they made intros, and then it kind of snowballed from there.
So we raised a seed round in September last year, and we just closed our Series A in August this year. So it was a lot faster than we thought, actually. We thought we would go raise early next year. And we can get into the detail of why.
Yeah, I was going to say, what do you attribute that to?
Well, originally the plan was to get to some milestones of traction, product development. And then, in my opinion, what we heard about fundraising is really great and was a really great pitch by a great presentation by Ellie. There's a whole part of the fundraising process which is deal dynamics, right? That matter a lot, and in our case, that went a little faster than we expected. So we got good deal dynamics, good, traction on the basically on the VC market, and that's why we went a little earlier. So we're not planning on raising another round for a couple of years.
Okay. Is there a reason why you're deciding not to raise a round?
I mean, if you raise it early, you hurt the dynamics. So we're not raising. We actually might be raising, but the less you're raising officially, the better.
So we raised a $1.85 million seed round in early 2014. That was pre-launch, just with kind of the idea. We launched the business on April 22nd of this year, and then we closed our A round in early August of 13.1 million. And so that round came together pretty quickly post our launch, and no plans to fundraise in the immediate future. But in general, with both rounds, I think it's a lot about kind of setting milestones and then seeing how you're doing to achieving those milestones. And I think it's a lot of times up to the entrepreneur, the team, to set what those milestones are and then how you're achieving them as a way to think about future fundraising. So for us, we are building our own products and marketing those products. So we look at a few different milestones, both on kind of traditional e-commerce metrics with like customer acquisition costs and determining what channels are working and how those are scalable, but also on product development. So to continue to invest and lead with product is something that's really important. So multiple milestones to look at and kind of all will guide us as to how we think about future financing.
And Philip and I both have board meetings tomorrow morning, which is something that changes after you raise a Series A. But we raised our Series A in April. That was a $10 million round. Previously, we'd raised a Series Seed in October. That was a $3 million round. The difference between a seed and an A is how you market it. And so I think it's just important to set expectations properly. As you said, the A is as you start to scale the product, you've had fit and you're starting to grow revenue, and then the B is to really take it to the next level. And so for our business, we wanted to make sure that those names and terms aligned with investor expectations. So I think that's really important.
Did you say, it seems like you all had a pretty easy process of raising money? Did anyone have a hard time where you're like, you guys should stop this right now and get some more traction before I go out again?
So the seed round was very painful. At that point, it was really just an idea. A big part of our business is the brand, and we couldn't really show people the brand, and you can't really talk about it. At that point, we didn't have a product in the marketplace, so who knows how people would respond to it. So definitely, seed often takes a bit of a leap of faith, and I think part of selling the seed round is convincing someone that you know what you're doing, and that convincing them to take that leap of faith with you, and it's up to you to kind of tell that story and paint that picture. But it's often not around hard metrics or specific traction. It's just telling them a story, that you have a good vision for what you want to accomplish, that hopefully it's a big enough vision that's exciting for whoever's investing, and that you're the team that can accomplish that. And then the later stage financings, I think, get more and more about metrics and execution and showing that you have figured out the economics of customer acquisition or lifetime value and things like that. So what you have to do throughout the process is definitely changes as your company gets more mature and as you have more confidence in kind of the KPIs or metrics to drive your overall business.
Yeah, and you specifically, you have a consumer products business. You have a mattress, right? So, and I've seen some of these companies come through. I'm investing mostly in financial technology. I see a mattress. I don't know how to value that. How do you decide who to approach?
Yeah, and that was one of the interesting things. When we were raising our seed round, we got told no a bunch of times, dozens of times, and everyone was focused on this customer acquisition cost and lifetime value. And you're selling a mattress and that's expensive, but you don't have this lifetime value because you can't sell them, whatever every month and continue to monetize that customer. And then fast forward to the seed round where we had some traction and we had launched and the product was well received. Not one person asked us about CAC and LTV and all that stuff. So as you get more confidence about the different drivers in your business and what it takes to scale that business, you just get to change kind of the story that you tell. And traction helps you kind of drive that conversation. But it's definitely, investors change their focus based on momentum or milestones or different things that occur in the life cycle of the business.
And I think just to that point, I think it's also just thinking about what you think your business is. For us, we're a healthcare company. We're changing healthcare, but we think of ourselves as a service company. So we specifically didn't go after any healthcare investors because we felt like there was a lot of noise there and we wanted to see ourselves differently. So for us, it was slightly easier because we didn't go after healthcare investors and we wanted a very specific type of group. So I think a lot of it is what is the expectation of what you think your product or your service is, and then what is that best match to an investor.
So how did you end up finding those? So how did you find those people? Because like you said, you had this other set of people, and how did you get intros? Because Ellie's right, warm intros are always the most important.
Yeah, we started first for our seed round with just people we knew that happened to be at VCs. It was personal connections through first round capital and OATV, and that's how we got our seed. For our Series A, and this is really the best advice I could say, is to take every single meeting. Even if it's an investor see what's resonating and what's not. But also, this is a marriage. You're in this for all intents and purposes for life, and they're going to be with you throughout the entire course of this of everything. You might be pleasantly surprised or disappointed. You might think that a company might be great, and then you go in for the pitch and it's just a disaster for whatever reason. So take every single meeting, and it's part of the job of being an entrepreneur.
Would anyone disagree with that? Would say.
Yeah, I would say the only counterpoint to that, which Ellie made, is that fundraising is a huge time suck. It's a huge distraction, and you don't get to really work on the business and do fundraising at the same time. So to the end that you can know some of the people that you might want to be talking to, and that's why it's not, you know, a lot of these relationships you're building when you're not fundraising, when you're just meeting people at events like this, or you know, some of the people that play more in the Series A world, maybe you met them in the seed stage, and you just start to get to know who you would potentially like to play with, and it's definitely a good point that it's something where you are, it was explained to me, worse than getting married because you can't get divorced from your Series A investor. So it's a serious commitment, but it is a huge time commitment as well, and so to the extent that you still have to run the business, I would try to balance those.
Yeah, I was just going to add that point. So it's funny because Ellie said you kind of have to come to terms with actually fundraising. Okay.
You basically have to come to terms with the fact that you're fundraising. So you approach it the same way you'd approach research or, you know, market research or your product, and you're basically creating massive spreadsheets. You know exactly where your leads are coming from. You know if that there's intros from founders that aren't going through, maybe that's not the best founder to go through, and you can get really specific and actually look at, you know, how successful specific funnels are of how you're getting intros. And so I think you just, as long as you're kind of running it like a process, so you start off with angels or you start off with super angels, and then you move to seed funds, and then you go to kind of, you know, early VCs, and you have an exact kind of week-by-week plan, it tends to run pretty smoothly, and then you get feedback so quickly because you're doing 10 to 20 meetings a week that you quickly kind of learn what's working and what's not.
I'd love to add, every story is different, right? In our case, the seed round, just like you, was very painful, long, painful, stressful. We thought we'd never get it.
How long? About how long?
So it was particular because we started raising, and then we got into Techstars. We stopped raising, we did Techstars for 3 months, and started raising again. So after Techstars, it took us 4 months, so that was not too bad. But the whole process was almost a year. And I think we saw way too many VCs, actually. We took way too many meetings. And the thing is, what you got to understand is, it's a small world where VCs know each other, they talk to each other. So if you're on the market too long, it's just like a house. If you're on the market too long, there's something weird, right? The only way you can get funded is to be the red hot deal, right? Create that dynamic where you are the red hot deal and everybody wants to get in. So we still managed to raise our seed round. We found a real believer. It was really awesome. He was actually our best ally when raising the Series A. He's a fund. So he's the guy who led our seed round actually doesn't do Series A at all. He's on the West Coast.
Who is that?
Triple Point. Ben Harrison. Really great guy, and he was really helpful in helping us navigate, the VC world on the West Coast for the Series A. So for the Series A, we blocked 1 week, and we had meetings the whole week. But that's the only week we pitched. We saw probably 12, 13 firms, and we created some good interest, and then we managed to close quickly thanks to that. But we only selected top-notch firms that we really wanted to work with. And that would help us build that momentum.
So how did you get to Triple Point originally?
So Triple Point was during our seed round originally.
But in your seed round before your seed.
How did we get to them?
Yeah.
Well, after Techstars, we basically took every meeting we could. Okay. But the thing is, we already had seen a lot of VCs, and usually when somebody tells you no, they will tell you no again. Even though, unless you really have some really massive news, it's a lot harder to get back to a firm that already told you no than to see them for the first time. So we ended up taking all the meetings we could, and this was among the last meeting we were taking. We were about to say, okay, let's go back to angels, continue to bootstrap. So it was really short.
Yeah, I'd be curious. So how many meetings do you think, and rough count of how many you took before you closed, and whether it's in the seed or for the Series A? And the other question on that is, did you leave New York City, and was that, you did? Did other people leave New York City? Was that just in the A, or was that in the seed? And how did you know, and was it just to the West Coast? Where else did you go?
Yeah, I can give you quick numbers on our meetings. For the seed round, it was about 90. And for the Series A, it was 13 or 14.
Okay.
And yeah, we went for a road trip West Coast.
I would agree with all that, and I think the point that Suzanne made was emphasized before, but get intros from founders as much as possible. So the best meetings we got were from other founders where the investors have invested in them because they trust their judgment, and the founders have sometimes the best perspective on new companies. And then the second point, which is to your point about round dynamics, the way we've thought about it is get a term sheet as quickly as possible. And so that means maybe take a few more meetings that you don't think you're not sure you necessarily want those investors, but once you have a term sheet, the deal flips, and you're now in the driver's seat, and you can dictate how quickly things close and what meetings you're going to take. And now investors are now fighting to get into your deal versus the other way around. And so when we think about, when we thought about our Series A, it was, okay, how quickly can we get to a term sheet? Because once we have a term sheet, then the deal is completely different.
And coming off of that, right, valuation is an art. You get this term sheet. How did you decide, like, this is a good valuation, this isn't a good valuation? Did you go in with expectations? Did you kind of lead the investor? So how did you figure out what you were willing to give up?
Yeah, so, I mean, the rough math is that you're going to give up 20% of your company in a round. So if you say you're raising a $10 million round, then you know what your valuation is going to be. So we set out to raise X number. For us, we actually set out to raise 7 or 6 is what we told investors. That got people more comfortable actually giving us a term sheet. And then we actually wanted to raise 10, and other investors came in and said, oh, actually, well, we'll put 7 on the table, we'll put 8 on the table, we'll put 9 on the table, we'll put 10 on the table. Great, now we have a round together that we want to do. And so one of the good pieces of advice I got was, especially if you're raising, a smaller round, go out and set a smaller bar, because once you get to 50% subscribed, the second 50% happens really quickly. So if you're raising like a $2 million seed, I would probably go out and say, oh, I'm trying to raise 1.25, because once you get to 600K, the next 600K is super quick, and then you just oversubscribe and get to your 2 million.
Were you filling the rest of the round, or was it your lead investor that wanted to bring some other people in?
We had to deal with pro rata, which we had a seed investor that could also participate in the Series A, and so we had competition on that front, which gets interesting. And so that's actually a lesson learned. Like, you want to make sure your seed investors are strategically picked to either lead or not lead the next round.
I think it's a good point about taking meetings and knowing, like, referencing your investors too, because if you are a really good deal, there's a lot of people that want to get into it, and then you get to choose who you want.
And the difference between a really good deal and not a really good deal is a few meetings or phone calls. It's often one person being excited enough to get a term sheet down. Now it's a really good deal that everybody's fighting to get into.
Exactly. So you guys have taken a lot of meetings. Has anyone taken more than 90? Because that was you did. How many did you take?
So our seed was over 100 meetings. And then for our series, this kind of current round was probably 40 meetings.
Okay,
so to be clear, so our round is still convertible debt. It wasn't an equity round, so we had the cap, we had the price determined. It wasn't, kind of rallying to get a term sheet. So it's kind of run a little bit differently than I think if it was an equity round.
So how did you do the process differently from, like, if you look at yourself at meeting 1 and then meeting 100, or maybe meeting 80, because at meeting 100, I think you're probably like,
so for the seed round, it's getting a little nutty. It starts off where your hit rate just isn't good. And I was actually looking at my spreadsheet. I was like, the percentage of no's to yes. And then as you get towards the end, you're like, every single meeting is a yes.
And so do you think was it things that you perfected the pitch with, or was it just the confidence it was having the term sheet?
So I think basically it helps to obviously have your round like 70-80% done. And then obviously you also are getting the same questions over and over again and kind of know exactly what to expect.
And did any of you learn like lessons learned from, from when you raise your seed to when you raise your A, or after doing so many meetings, things you want to do, things you don't want to do?
I mean, we had, one of the big lessons learned was to lead with a big vision, and that we didn't have in the beginning. So in the beginning, we're like, oh, we're trying to build a site to get young people involved in politics and other news, and people are like, what the hell is that? Versus, if I were pitching Airbnb 3 years ago, I would probably start the meeting by saying, by 2016, we're going to own 30% of hotel bookings worldwide. That's a $150 billion industry, and we're going to have 30% of it. And then you get people's attention, and then all of a sudden it's like, can you actually back up your big statement that you started with? And people are going to start peppering you, and you don't even need your deck anymore, because now it's just a Q&A to see if you're bullshitting or not. And so when we did our A, it was much more start with a big vision, make it very clear that you're trying to accomplish something huge, because that's what investors want, and hopefully that's what you're going to try to do if you're talking to them. And then it's really, can you prove that you have what it takes to get there, and that your current traction is bringing you in that direction? And that's what the meeting is all about then, versus walking them through a deck, which usually is not very helpful.
And so the questions, and when people went into deep diligence with you before you got the initial term sheet, where were they focused on?
It totally depends on their experience level. People do a lot of reference checks on the team, is what I found. So same thing as hiring somebody. People will look at all your numbers. For us, we're a media company, so people take our Google Analytics, and we have to be comfortable giving our Google Analytics to investors. They'll call customers and see how you performed. I mean, when you get into these multi-million-dollar rounds, usually they do diligence, at least a little bit.
Did anyone have an experience where the investor didn't do any diligence, or not much? No. Did anyone go too deep, or no? No. All right. And was there any kind of surprises through that process that you're like, oh, I wish I knew they were going to ask me for this or this, or, oh, I wish I had my deal room all prepared, or, I mean, was there anything, or was it just exactly what you guys expected?
Agreeing on a cap for legal fees.
Okay. was there anything else in term sheets that threw anyone off? I guess that's why they all raised money so quickly. They were way on top of it.
One would be the employee option pool that we weren't paying attention to in the seed. And so people say, oh, you need to bump up your employee option pool to 15% for new hires. But the way that works is actually on the pre-money valuation, so all that dilution comes out of the current team and founders versus out of the new equity. And that was one thing we missed in the seed that we didn't miss in the A. But important to think about. Hopefully your lawyers tell you.
And how helpful have your investors been, whether it's through the fundraising process, right? Because after the seed, you have investors that are in. Are they making intros, or those intros panning out? And then, post Series A, you've taken, you've all taken in a decent amount of money. You have boards. Do they actually add value? Are you glad you chose who you chose? Or have you made different decisions?
Yeah, I'll say, so our seed round was led by Lear Hippo Ventures, and they're like one of the most active, if not the most active seed funds in the country.
Can you call out Nicola? She's here.
Shout out to Nicola. And so they've been super helpful with introductions. They know any company that we want to talk to, or any potential investor that we want to talk to. So it's they've been tremendously helpful for the business and just being strategic. And at the same time, like also, leaving you alone when, you don't need to be over-reporting or worrying about, certain things that could take you away from kind of execution of the business. So I think they definitely kind of apply the right amount of help for you. And then with our A investor, they seem great. It's just, it hasn't been that long. So NEA led our Series A round, and they're also very active, tons of companies, tons of investors, strategic people to help. And so I think that's where who your investor is and what fund they come from can make a big difference.
Yeah, and we share our lead investor, right? NEA is very helpful. And So there's a lot of things VCs do to help you build your company, fine-tune your vision. I think the main criteria, though, in both our rounds was to choose our VC as the ones who are going to help us raise the next round. That was very important, and that so far that's what happened. So I'm happy about that. Then you were asking about advice. For instance, don't underestimate deal dynamics, and also you need to be helped to navigate the VC world, right? So in our seed round, I had some relationship with some of the New York VCs that helped me understand a little bit. So Techstars helped us build a pitch, right? Have a perfect pitch. Some relationship with VCs who are obviously not going to invest because they don't do seed or because it's not their kind of market. Very, very helpful actually, because then they can help you navigate and understand a little better and do intros as well.
So yeah, our seed investors were SV and Joel Rothenberg Ventures, and so they see high deal flow all year round. And so I think one of the things that are really helpful is that as you're going out, they can tell you how the market's feeling. They kind of have their pulse, and they also can help you with whether it's the pricing, what the cap is, what they're seeing, what types of deals are actually getting funded, and generally, they co-invest with a lot of other, whether it's seed funds or angels, so they can make great intros. And so I think that's very on point, is that you're looking for people who can kind of help you. BD is great, but there's also the fundraising is like what they do full time. So if they can help you kind of set up for the next round, a year from now, a year and a half from now, that's perfect.
Yeah, you seem like you guys all have solid investors. Did you reference them, or what did you do to make sure you wanted these people?
So for me, I had a previous company, so I'd worked with some of the investors before my last company, so I already knew them. And then all the other great VC interests of company founders. And it's generally founders who've worked with them or they went to school with them. And so they just know them personally.
I mean, we did a lot of going out, talking to them, going outside of just sitting in a boardroom, because again, it's a marriage, so we want to make sure that you can connect and be honest with each other, because I think that's important. And we did our diligence too. We spoke to, and they were open to it, spoke to founders of companies that they had invested in and said, what was your experience? And that's always super, super helpful.
Yeah, we always encourage our entrepreneurs and talk to anyone I invested in before, and whether it went well, the company did really well, or even when it goes not so well, because it's really easy if I back an entrepreneur and it's a great exit, it's great for me to be really pleasant, but always good to diligence, am I just as pleasant? I think I am, but if things go bad, am I supportive? Do I always support? I think when you're talking about deal dynamics, it becomes really interesting once you're exiting, or if you do hit trouble, and will people bridge you? Has anyone taken a bridge here? Yours was sort of, but no one's been in trouble. So I think it's a very, very good point to reference your investors, talk to entrepreneurs. One, not just to get the intro, but really get recommendations. And there are people that have better reputations than others because it is such a small ecosystem. You should really be able to suss out who's good and who's not. Does that be a fair assessment? Yeah.
The only last thing I'll say is pick the partner, not the firm.
Yes.
Pick the partner, not the firm. A lot of firms have great brands, but I think what we've all learned is you're working very, very closely with one person, and he or she is going to be the decision maker and the make or break it for you in terms of future financings with that firm, in terms of how they handle things when they go wrong, or anything else. So for us, when we raised our seed, it was led by Jeremy Liu from Lightspeed. Lightspeed is not necessarily a super consumer-focused fund, but we love Jeremy, and that's how we ended up going with Jeremy for the seed. And that's been awesome. And so, just make sure you figure out who the partner is going to be, and you and that person are ready to get married, because it's much more you and that person than you and the firm.
Mm-hmm. Definitely. And I think the only thing I kind of a slightly different view of Ellie with about associates at firms, and she's right, some firms have bad associates, but I think at a lot of the VC firms and the ones that are reputable, I'm not sure how much you interacted with the associate at all, but I know I depend on mine, at least for initial scans sometimes, and then they come to me. I think an associate just being involved after one meeting wouldn't be good if it's only an associate involved, but I'm assuming most of you have taken first meetings with associates and then it got escalated up. Or you would never take a meeting with an associate? Okay. You didn't either? Okay.
We met with
You did? Okay. And did
post financings, we do a lot of work with associates. I mean, it's just they have a different view on things.
Yeah, they do, and they tend to have a little more bandwidth to bang out some of the work and do some of the harder stuff that you may want them to do. You do? Yeah.
We can't hear you.
Sorry. I was saying we didn't take meeting with associates on purpose during the Series A raise. First of all, because we had a very limited amount of time. So you have to choose between a meeting with a partner and a meeting with an associate. We had to choose the partner. And it was kind of tactics also to create some dynamics. But once you get closer to due diligence and all that, of course you work a lot with associates.
So one more question before I open it up to the audience. So given you've all been in the ecosystem for a while, how do you feel about the current fundraising environment? If you're not actually raising, I'm sure you have a lot of friends are. Or were you tempted, if you think it's costly, to take more money in case it goes, if it increase it goes down? And how did that kind of external factors depend on what you raised this past round?
So there's definitely a lot of money flowing around now, everybody knows that. We hesitated, I mean, we on purpose didn't try to raise more. Think of the fact that when you raise money, so we raised 7 actually in a Series A, 6, sorry, in a Series A, 1.7 in seed. We chatted about that a lot with my co-founder. We decided to stay there, not go higher than that, because I mean, maybe it's particular to our company, but when you set the valuation to your Series A, you set the goals for your exit to your Series B, and that's a big commitment actually. So we chose to stay, kind of relatively modest by today's standards with 6 million.
Yeah, and I would say, before you go through a fundraising process, you should try to think of what you want to optimize that round around. And that should also drive some of your decision if you should be fundraising. So, there are certain founders that just want to maximize the economics of how they stand and want to get, every penny from the company that they're building out of it, and that's great. That'll drive you down one path and one set of timing decisions. Some people want to de-risk the business and put a little bit more cash in the bank just to give them some certainty about going forward, and who knows what happens on the macro trends. And then who you talk to also. There are certain VCs that can do larger deals and have to have certain equity ownership levels. There are VCs that have less ownership requirements and are generally like smaller funds, and all of that drives kind of what you end up optimizing the roundabout, and drives kind of your timing and when you should do it.
Yeah, I would say the only thing we think about in terms of big picture market dynamics is how our industry is evolving, and so we're while the whole tech and media ecosystem is definitely hot right now, media is especially hot compared to how it was 2 years ago or 3 years ago, and how that evolves over time is just something that we make sure we're watching, even though in the back of our minds, we know that our core business and what's happening with our core business is the most important thing by far. And so if we can become profitable, grow users, build a good brand, we're pretty confident that if we manage cash flow, we'll be in a good position versus betting the bank that the market is going to continue to be hot and paying less attention to those things. So it's a hard balance, but I think you can't go wrong when you focus on the core business.
Exactly. So I'm going to open up to some questions from the audience if there are any. And hopefully someone has a microphone. Or you could scream it and I'll repeat the question.
So, Mike, there was a lot of discussion about diligence, and I was wondering how did the founders, when they were building their original teams, how did they do diligence on those people? And if there were any changes from the original team to what evolved in your rounds, and if so, did you have to do some pruning? How did you do that? Kind of walk me through some of the management issues you had to make early on through your finance process.
Perfect. So just to repeat the question, he was asking about in diligence and one for the founders, how to do diligence your own original team members and decide they'd be good for fundraising. And then if there was a change, it would be interesting to hear if any of you actually had to change someone else in the management. How do you explain that during the diligence, and how did that go?
Very short answer. So there's a book, The Who, the A+ method for hiring. Really, really good. We almost saw it to the T. And the best thing we've ever done is off-list references to the max. So we almost don't even call the references that people give us, but we call 10 authorless references. And you'll get all the color you need.
And that's what VCs will do too. So if I want to learn about Chris, they'll give me a list. I'll probably call one or two of his lists. And of those, ask them, is there anyone else I should be talking to? But more importantly, LinkedIn is so prevalent. I'll see who are the other 20 people I know that know Chris. And most of them my buddies, and they'll give me like the list group on him or CTO or how they're getting along. Yeah. Anyone else?
The book was the who? The who, the A+ method for hiring.
The who, the A+ method for hiring. Anyone else have any management changes or had to augment their management team to raise?
Mine was, this is regarding the previous, so the company that I'm working on now is actually a big pivot from a previous product, which is completely separate. It was actually in the health food space. And so when I made that change, I had to let my co-founder go as well as my entire team. So it's actually a lot of changes in the company, and then I learned a lot from those changes when thinking about the next team that I wanted to bring on.
Awesome.
In that scenario, when you pivoted, did you just basically have to like form a whole new company?
No, so I actually, we had raised a small kind of seed round, and so our investors were really all fairly supportive. They were all angel investors. They were all operators. They totally understood, and we made the decision really quickly, actually, after we raised the round, because we realized that the dynamics of the market and the actual margins of the business weren't as attractive as we thought they were. And so all of them said to keep the rest of the investment and just, we invested in the team, so they said, go build something else.
Yep.
How did you value your companies and how did that change in the year? Like, it sounds like all of them went from Series A to Series A.
Yeah, so she's asking about how they value their companies first in the seed, then in the A, and how that change was. If you guys don't want to speak in round numbers, if you just want to go, hey, we had a 50% increase, or we had however you feel comfortable.
So for us, we started off just by looking at other market comps, because there's so many other companies in the space or similar spaces raising, so we just wanted to understand, what valuations they were getting, and we started there. And then we looked at the actual, what our product and our business was. So, the seed round is tough because you don't really have a business yet. You really just you might have a product, you should have a product, you have a team, and so we kind of valued it from that. And it's usually within certain bounds. Like, you can look at the companies coming out of accelerators, you can look at the companies coming out of YC, and so you get a range from that. And then when we raised our Series A, we had built a lot more product, we had shown traction. The team actually stayed exactly the same. We didn't really grow the team. But we had enough to kind of bump it up 2x.
Not to be, non-idealistic about that, but valuation is seriously just a negotiation. You want to raise that much, you're going to let go, 15 to 25% of the company. That basically works.
And there's this question, yeah?
Yeah, my question is with regards to accelerators. How early did you get into them, and what was the biggest takeaway in terms of just getting references or getting information that we see how people want to get to know you? What does that really happen like that? What do you get something like this out of?
And so his question was about accelerators, what they learned the most about, and how to get in.
Yeah, we both went through the same accelerator, Techstars in New York. And so yeah, your network matters a lot, right? References. You got to look at all the mentors and the former companies and try to get references from these guys. And then these guys, they bet a lot on the team. So after a while, after we finished Techstars, they finally told us that 80% of the criteria is really the team. So it's like an interview when you're looking for a job, right? You're really going to gauge your personality, your ability to get to the goal that you're promising. So it's really that. For us, to how useful it was for us, it changed everything. It was extremely useful. First day, I don't know if they told you the same thing, but first day they told us you're going to do in 3 months what you would do in 2 years with your company. I think that was actually an understatement. It's really impressive.
Yeah, so I had a similar experience. It was just completely game changing in terms of what you kind of get put through a boot camp, and you're forced to just work on these crazy timelines, which is great because the entire team experiences it. For us, when we didn't go through this standard application process. We were kind of just meeting with the MDs and the people at Techstars, and I actually think that's probably the best route to go. Is you're a founder in New York, there's absolutely no reason why you can't get connected to one of the people who work at Techstars. There's so many of them floating around. They love to meet with founders. They're looking for the next startup. Like, just get yourself in front of them.
Awesome. And one more question in the back. Yeah?
Is there a question that you always ask VCs, like a sort of core thing that might not be intuitive to think about?
You can ask me anything.
I think, so this is more just about understanding what drives them. Because different VCs and also the size of their fund, like what is the actual dynamics of the partners and the LPs and what they're looking for. Because you're going to have a working relationship with them, so you want to make sure you're setting those goals and everything's kind of aligned. So I tend to ask them what they define success as. And so you get a sense of, well, success is IPO, or success is the founder is happy, and I think it's really different, and you can kind of get a sense of that VC or that investor when you understand what drives them.
Awesome.
I'll just say, whenever you ask a VC like why you should go with them, or however they try to sell you on the VC fund, I think like 95% boilerplate and everyone kind of has the same pitch, and then there's usually 5% or something that's unique or different, and I think that's very telling of what's important to them or how they built their fund or why they did that. And that like the part that's unknown is the interesting part, I think.
And also, we often ask for references. Actually, we have to talk with portfolio companies, and when they offer it, it's actually a good sign. So that's really interesting.
Definitely. All right, so we're going to wrap up here. I know we're running a little bit over, but one more question. So you've ran a Series A panel. Hopefully next year or 2 years or maybe a couple years, depending on what you want, to be here on the Series B panel. So have you identified who you want in your Series B? Do you think you end up blanketing the whole market, or do you think you know who you want? Are you updating them now? And most importantly, is there anyone, and you can feel free to call them out by name, who you do not want in your round?
Even though we're going to get raised only in 2 years, it's super important to keep relationship. I mean, the best relationship you can have with the VCs when you're not raising, actually. So we actually, I keep in touch with the ones I really like. Who I do not want.
I
don't know. I mean, I'm really happy with my current VC, actually. I really would like that, down the road.
So if all your current VCs said, hey, we want to do the Series B, this is going so well, would you still want to add someone new? And if so, why? And if not, why not?
Why would I still want to have mine?
Yeah, when you raise a Series B, would you like to add another investor? Or if all your insiders said, hey, let's do it, would you be like, okay?
I think we probably, you have to go see other investors. Again, you're dynamic, right? You can't just talk to your existing VC. So, I would definitely go with the other investors. But I think I'm a big fan of long-term relation, especially with VCs who are super aligned with what you do. So, I would go see others, but with the goal of raising from the same.
Yeah, there were VCs that told us no in the seed, and then we still wanted them in for the A, and so there are people that we talked to with the A that we maybe didn't choose, but were still interesting for down the road, and that was part of our process too, is just who plays kind of down the road and who only plays now. So I think that's all important, and I think you getting to know people when you're not fundraising is probably much more telling than when you are going through a deal process. Especially when they're only wearing their sales hat and trying to get a deal done with you. And then just seeing how they work with their portfolio companies and talking to those entrepreneurs, I think, is probably the most helpful thing. Because everyone has a different idea of kind of the board they want to build and the people they want around the table to build the company, and seeing what they're doing when you have the time to see that over time, who they're investing in, how they operate with those guys, how they're supportive of their portfolio companies that are doing well and not doing well. is probably much more telling than kind of just meeting them face to face, especially during a fundraising process. So it's something where you're always learning, you're always hearing different things about different VCs and seeing how they change and how their funds change and how their positions within the funds change. So it's something where you really can't take your eye off the ball because it's always evolving. It's a very dynamic environment and process, and the macro changes certainly impact all of that. So.
And anyone you don't want?
I want everyone.
Okay.
Yeah, I would say everything that everybody just said. Plus, we keep a list of the people that we're really interested in. We've already met probably all of them and are updating them every 3 months, perhaps, or whenever there's news or whenever we're in the same city, more casually over coffee rather than formal materials. And then lastly, in terms of who we don't want, people that are invested in our competitors.
Nice. Nice, still diplomatic, but nice.
I can actually give you a couple of names of some I want. One of the big thing we wanted to do and we didn't manage to do is have VCs in New York. I would really love to get Union Square. Albert, I think is one of the smartest guys I've ever met. And Roger Ehrenberg from IA. They're two of the major players I think here. They're really, really good. So hopefully one day.
So I think, for us, we would definitely work with our existing investors. They're all awesome. And so, but I think just to your point, we could definitely want to price it by talking to their investors. I think we brought in our first strategic investor this round, Technicolor Ventures, and they've already shown a lot of value add kind of within the first week. So I think we'll probably be more aggressive talking to strategics going forward.
Nothing additional to add there. We would totally go with our existing, but to your point, still take meetings and sort of see what's out there.
So a very, very diplomatic crew this evening. Maybe a couple more drinks will tell you who definitely they do not want to add. But I appreciate the panel. I saw a lot actually. I've met most of them pitching either for the seed or for the Series A. Hopefully, I tried. If we could have pushed it through, I would have. It's why I left Comcast Ventures and now am a partner at Core, so I can push a lot more things through. So if anyone has good fintech companies, definitely come this way. But congratulations on all your success. The fun actually only just starts after you raise the money and, like you said, focus in building the business. So looking forward to watching you guys grow and a lot of successful exits and seeing you again next time build fintech companies. Thank you.